now we are briefly going to look at IFRS 4, which deal with the insurance contract. This IFRS applied to the insurance contract issued and reinsurance contract held by the insurer. And this IFRS provides a temporary exemption from the requirement of IS 8 to the insurance provider in selecting the accounting policy. As you know, IFRS IS 8 give a criteria that when some pronouncement or standard does not prescribe an accounting policy to be followed, then entity can work out its own appropriate accounting policy by following the criteria given in the standard. So this IS does not require the entity in developing their accounting policy. They have to strictly follow the criteria prescribed by IS 8. And this IFRS requires the insurer to work out the liability adequacy test frequently. And if there is a shortfall in the liability provided in the balance sheet, the shortfall to be immediately provided through the profit and loss account. The purpose of this IFRS is to provide the user of financial statement information about the amount, timing, and uncertainty of future cash flow related to such insurance contracts. The insurance contract is a contract where one party accepts the significant insurance risk from other party by agreeing to compensate the other party, which is the policy holder, if a specified uncertain future event take place, which adversely affect the policy holder. The risk transferred from the holder of contract to the insurer does not include the financial risk. As you know, financial risk arise from various transactions where the interest rate change, security prices change, foreign currency rate change, commodity prices change. So in that case, the financial risk arise. So insurance risk excludes the financial risk. So provided that's not specific to the party to the contract. So at each reporting date, insurer must assess whether the recognized liability are adequate under this insurance contract. As I said earlier, if it is shortfall, then it has to be provided immediately through profit and loss account. But this IFRS does not require an entity which is already carrying out the liability adequacy test according to their old policy to do anything more. And then this IFRS talk about the treatment of embedded derivative, like there are certain insurance contracts which are embedded derivative involved, like the right to surrender. This is embedded derivative. So this IFRS does not require that it has to be separated from the host contract and recorded separately. And similarly, this IFRS requires when entity first time apply the IFRS 4 that they can reclassify some of their financial assets and liability due to the fair value through profit and loss account method. And this IFRS does not allow the insurers to record certain the possible losses which can take place, which are just expected, has not taken place. They cannot record that. And similarly, this IFRS require the insurers to unbundle certain component of insurance contract. We know there is, like if I give you the example of the insurance policy, term life policy and the normal policy. In the term life policy, whatever the premium is paid, that takes care of the risk of the death of the policy holder. On the other hand, if the normal policy, which is the investment policy, is as well, so that takes care of the risk of the death of the policy holder, as well as once the policy matured, then the policy holder do get back some amount. So basically, investment deposit component as well, and the risk carrying component. So this have required that the insurer have to unbundle that and account for both separately. Shadow accounting is not allowed under this IFRS, and this IFRS also allow the expanded presentation. Now, what is expanded presentation? Let's say in case of business combination, acquiring portfolio of insurance contract, if you pay just 10 million, acquire certain number of insurance contract from the other insurance provider, and you just paid 10 million. And you can record it as cash credit and 10 million as debit in your balance sheet, which you paid for as an asset, right? Insurance asset. On the other hand, what you can do is if those number of contracts involve the assets of 100 million, liability of 85 million, then what you can do is you can debit the asset by 100 million, you credit the liability with 85 million, credit the cash you paid with the 10 million, and the difference 5 million is recorded as the difference as assets or liability in your balance sheet, which is the asset is going to be intangible asset, will be spread over the life of the insurance contract. So also this IFRS deal with the discretionary participation feature, and there are certain insurance contracts where there is a guaranteed element as well to repay and some discretionary element as well. And IFRS required that with the guaranteed element that has to be recorded as financial liability, whereas the discretionary element that should be recorded as appropriation of reserves or equity. And this IFRS also permitted that in certain designated insurance liability cases, the entity can reflect in the balance sheet those liability at current market interest rates. So by providing this avoid the needs of going into change in accounting policy again and again. Otherwise, normally when you change this every time, bring it to the current market, it would require the treating the adjustment using the change in accounting policy. So this way they allowed that designated liability. You can designate certain liability which you can reflect in the balance sheet consistently using the current market interest rate. Let's give an example. You see, if a retail store is selling the photocopier and giving the guarantee to their buyers, their customer, its customer, that they can warranty, that they will repair the photocopier in case of some default in that, and they also offer this warranty to the customer of other vendors as well. So now question arises, will that be treated as insurance contract? Will the IFRS 4 apply? The concept is where in case of its own sale of photocopy, when they provide the undertake to provide the warranty, and that won't fall under the insurance contract because the retailer is the third party to the transaction. But in case of other giving the warranty to the customer of the other vendor, and then it's not specific to him, to that particular retailer, and that falls under the parameters of the IFRS 4, which is the insurance contract IFRS. So this IFRS also is the limited improvement of the accounting practices taking place, which is already prevailing in the insurance industry. And further more work is there, exposure draft is issued to give us come to the second phase and give a full-fledged accounting reporting standard in this area.